What are investment strategies? Investment strategies are strategies that help investors choose where and how to invest as per their expected return, risk appetite, corpus amount, long-term, short-term holdings, retirement age, choice of industry, etc. Investors can strategize their investment plans as per the objectives and goals they want to achieve. Advantages of investment strategies. Some of the advantages of investment strategies are as follows. Investment strategies allow for diversification of risk in the portfolio by investing in different types of investments. An industry based on timing and expected returns. A portfolio can be made of a single strategy or a combination of strategies to accommodate the preferences and needs of the investors. Investing strategically allows investors to gain maximum out of their investments. Investment strategies help reduce transaction costs and pay less tax. Limitations of investment strategies. Some of the limitations of investment strategies are as follows. Average investors find it difficult to outperform the market. To earn an average return from investments, it may take them years, whereas professional investors would earn the same return in weeks or months. Even though a lot of research, analysis, and historical data are considered before investing, most of the decisions are taken on a predictive basis. Sometimes, the results and returns may not be as it was anticipated, and it may delay the investors from achieving their goals. Number 1. Passive and active strategies. The passive strategy involves buying and holding stocks and not frequently dealing in them to avoid higher transaction costs. They believe they cannot outperform the market due to its volatility, hence passive strategies tend to be less risky. On the other hand, active strategies involve frequent buying and selling. They believe they can outperform the market and can gain more returns than an average investor would. Number 2. Growth investing, short-term and long-term investments. Investors chose the holding period based on the value they want to create in their portfolio. If investors believe that a company will grow in the coming years and the intrinsic value of a stock will go up, they will invest in such companies to build their corpus value. This is also known as growth investing. On the other hand, if investors believe that a company will deliver good value in a year or two, they will go for short-term holding. The holding period also depends upon the preference of investors. For example, how soon they want money to buy a house, school education for kids, retirement plans, etc. Number 3. Value investing. Value investing strategy involves investing in the company by looking at its intrinsic value because such companies are undervalued by the stock market. The idea behind investing in such companies is that when the market goes for correction, it will correct the value for such undervalued companies, and the price will then shoot up, leaving investors with high returns when they sell. This strategy is used by the very famous Warren Buffett. Number 4. Income investing. This type of strategy focuses on generating cash income from stocks rather than investing in stocks that only increase the value of your portfolio. There are two types of cash income which an investor can earn: 1. Dividend, and 2. Fixed interest income from bonds. Investors who are looking for steady income from investments opt for such a strategy. Number 5. Dividend growth investing. In this type of investment strategy, the investor looks out for companies that consistently paid a dividend every year. Companies that have a track record of paying dividends consistently are stable and less volatile compared to other companies and aim to increase their dividend payout every year. The investors reinvest such dividends and benefit from compounding over the long term. Number 6. Contrarian investing. This type of strategy allows investors to buy stocks of companies at the time of the down market. This strategy focuses on buying at low and selling at high. The downtime in the stock market is usually at the time of recession, wartime, calamity, etc. However, investors shouldn't just buy stocks of any company during downtime. They should look out for companies that have the capacity to build up value and have a branding that prevents access to their competition. Number 7. Indexing. This type of investment strategy allows investors to invest a small portion of stocks in a market index. These can be mutual funds, exchange-traded funds,